Welcome to the Three Edge Week in Review for the week of January 10th. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge. And joining me here today once again is Steve Cucchiaro, Chief Investment Officer here at Three Edge Asset Management. Today, Steve and I will be revisiting a topic from last year, which we referred to as regime shift in the capital markets. And this topic is now being brought into sharper focus thanks to the current surge in inflation, which seems to be changing both the economic and investment landscape away from a period of falling inflation and low interest rates and potentially towards a period of rising inflation and rising interest rates. Since the beginning of this year, investors have been on edge over fears that increasing inflation and the prospect for higher interest rates could weigh on both stocks and bonds in 2022. Then this past week, inflation took center stage when the Bureau of Labor Statistics reported last month that the Consumer Price Index, which is a common measure of inflation, increased by over 7%, and this was the sharpest increase since 1982. As a result, Wall Street is now forecasting that the Fed may need to raise short-term interest rates as many as 4 times this year and beginning as early as March. So let me bring Steve into the conversation right away. And let's revisit the topic of regime shift because surging inflation now seems to be the number one topic of discussion among, everyone. So let's level set and let's discuss what is it that is actually causing inflation at the moment, how might the Fed react, and what are the tools available to the Fed to fight inflation. But Steve, let's just start with how did we get into this situation now with inflation surging as strongly as it is?
Fritz, while COVID is partly responsible for disrupting supply chains, our research suggests that it's the excessive monetary and fiscal stimulus that's the primary culprit. To fight a feared economic downturn from COVID, the Fed printed more than $3 trillion out of thin air over the last 2 years. And that's more than they did in the previous 107 years, just extraordinary monetary stimulus. And at first, the stimulus stayed in the financial system and inflated asset prices, mainly the stock and bond market. And that's why they're so overvalued. But then the government introduced fiscal stimulus that put funds directly into the hands of individuals and businesses. So now the funds are flowing more directly in the real economy, and that has resulted in the highest consumer and price inflation in 39 years, as you mentioned. Government added trillions to its debt in the process, however. The biggest lender to the government during this time period is the Fed with all its printed reserves. So this debt can either be paid with higher taxes or higher tax rates or by the so-called inflation tax, which is less visible but nonetheless reduces purchasing power. Now, given that we're seeing rising rents, rising food and energy prices, rising wages, new supply problems coming out of China, and many of these things that haven't even hit the consumer price inflation statistics yet, we think reducing inflation might take a greater effort than most expect. And up until recently, I'd have to say it seems as though the Fed is fighting a fire-breathing inflation dragon with a water pistol.
Excellent. So let's cover a topic real quick, and that is something I think investors should understand, and it's something that's referred to as the Fed's reaction function. So what are people talking about when they are discussing the Fed's reaction function, and why is it important?
Well, because monetary policy operates with a lag. It typically takes several months after the Fed begins to raise rates before inflation begins to stabilize and then turn down. That is why the Fed is typically late fighting inflation and why we have these inflation cycles over time. Presently, this Fed has been unusually late in reacting to inflation, presumably hoping it would decline on its own without needing to resort to rate hikes. Or perhaps the Fed is quietly pleased that inflation is rising so that an overly indebted government can more easily work off its debt burden by repaying its loans in the future with cheaper dollars, much like how the government worked off its World War II debt back in the 1940s. This is called financial repression, and effectively it taxes the bondholders by offering them negative real rates or below inflation negative interest rates. In any event, even now with 7% inflation, the Fed to this day continues to print money and has only begun talking about raising rates. However, the Fed will now be under increasing political pressure to act as complaints about inflation accelerate.
Excellent. So now keeping with that concept of the Fed's reaction function, let's consider what exactly are the tools available to the Fed to respond to higher inflation.
They've talked about three tools that they've explained recently. The first one they talked about is tapering, and that's simply printing money at a slower rate until they stop printing money altogether. And originally that was going to happen by June and it would be done. Now they're saying it should be all done by March. So that's first. Second aspect is once that's completed, then the Fed said that they plan to begin to raise their federal funds rate. They didn't say that they would do it immediately after it's completed, but at some point they said they would begin to raise the rate. Well, that rate is currently at 0%.
Right.
Typically, the Fed funds rate is 1% to 2% above inflation. With inflation now at 7%, for them to get the Fed funds rate to 8%, which is typically what you need to keep inflation under control, that would be 32.25% rate hikes. So you got a long way to go.
Yeah.
The third aspect is that sometime after the first rate hike, they talked about reducing the size of their balance sheet. And what they mean by that is that as they've used the printed money to buy government bonds, when the government bonds mature, they then reinvest the money that they get from the government back into other government bonds.
Maybe the most important question today is, so what are the ramifications of this potential regime shift in the global markets should inflation remain elevated and remain more persistent than previously anticipated?
So the rules that govern market behavior change when the overall economic market environment or regime shifts. By example, from 1940 to 1980, the regime was rising inflation and rising interest rates, and that favored value and dividend stocks, and it favored real assets over bonds. Then we had a major shift in the early 1980s when Volcker drove interest rates up almost 20%. And now from that period to 2020, we've had a regime of falling inflation and falling interest rates, and that favored growth in speculative stocks and bonds over real assets. More recently, we are witnessing a regime shift back to rising inflation and rising interest rates, and that appears now to be well underway. Therefore, we are positioned to benefit from allocations to value and dividend equities, and we are now favoring real assets over bonds. How quickly the Fed reacts to the current inflation spike will influence how we adjust our allocations going forward. And generally, though, we are defensively positioned because we see the risk of a major correction rising as the S&P index, 500 index, has become excessively more overvalued. And at the same time, the prospect that all the causes that drove the stock market ever higher, that those causes can now be taken away in the not too distant future.
Right. Great. Thank you. Thank you for that very clear explanations around a very, very important topic. It was interesting because when I was preparing for the video today, I couldn't help remembering that it wasn't that long ago when everybody was talking about how it would never be possible for the Fed to ever get inflation back to their 2% target again. And, obviously now they've accomplished that goal and then some. So we'll have to see how the rest of the year plays out. So that will do it for Steve and me. Remember, all our videos are available on our 3Edge YouTube channel. If you would be so kind to subscribe to our 3Edge YouTube channel, we'd be most appreciative. And all of our videos and written commentaries are also available on our website at 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.